and may say that someday they will make that much, but in reality, most people are just dreaming. The statistics verify this reality. The harsh reality is that 99% of the U.S. population will end up making just above the $25,000 mark, somewhere between $25,000 and $50,000 a year after they retire. Most will follow in their parents' footsteps. Rich Dad always said, "Your future is created by what you do today, not tomorrow." A plan is the bridge to your dreams. Your job is to make the plan or bridge real so that your dreams become real. If all you do is stand on this side of the bank and dream of the other side, your dreams will forever be just dreams. First make your plan real, and then your dreams will come true. Between 1985 and 1994, Kim and I worked on making our plan real rather than dreaming of our dreams. We practiced every day, preparing for the day when our window of opportunity would appear. Once it appeared, we took our shots and then the window closed. As Rich Dad said, your future is created by what you do today, not tomorrow. One of the first steps in changing your financial future is to stop doing today what you do not want in your future. Start asking yourself how you can learn to work for passive and portfolio income. Once you come up with some answers, make those answers a part of your plan. It may mean studying more, reading more books, listening to tapes, attending more seminars, starting a home-based business and meeting new friends. In other words, do today what you want for your tomorrows. How do you see the future? I am also often asked, how do I see the future if I cannot see it with my eyes? The answer is found in something my rich dad said to me years ago. Sight is what you see with your eyes. Vision is what you see with your mind. When I asked Rich Dad what improved a person's vision, he said, words and numbers. He stressed the importance of learning how to read financial statements, because you could not see your financial future if you could not read financial statements. In fact, if you cannot read a financial statement, you cannot see your financial past, present, or future. I created the cash flow games to assist people in improving their mind's vision by teaching them the numbers and vocabulary of rich people. One thing that has worked for many people is to get a group of friends together to play Cash Flow 101 on a regular basis. Once you have Cash Flow 101 mastered, you may want to teach it to others and inspire them to take action. Or you may want to move on to Cash Flow 202, the more advanced game. The reality is, the more you play the game, the more you teach the game, and the more you make the game a part of your life, the better your vision of the future will become. Fast words for fast plans. If you want to create a fast plan, you need to learn to use fast words. When it comes to money, millions of people use word tools that are slow and antiquated. Rich Dad said, words are tools for your brain. The reason so many people struggle financially is because they give their brain old, slow, and obsolete tools to use. If you want to be rich, you first need to update your tools. Most people think it is smart to save money. Saving money is slow. You can become rich saving money, but the price is time, your lifetime. So to me, save is a slow word. My poor dad taught me how to save money. My rich dad taught me how to raise capital. A student in one of my classes asked, but what if someone does not know how to raise capital? Then it is best you save money or invest some time learning how to raise capital. Raising capital is a learned skill. But isn't it difficult to ask people for money? Asked the student. It was for me at first, as learning anything new is. It's just like learning to ride a bike. I was very nervous at the start and made mistakes at the beginning, and I still make mistakes today. Yet I learn from those mistakes, so my education and experience makes raising capital easier and easier the older I get. So while I struggle to save $100 a month, you can raise millions of dollars in the same time, another student chimed in. That is what you mean by words are tools, and that some words are fast and others are slow. I just nodded and said, words are tools for your brain. Plan to use faster words. If you are creating a plan to retire young and retire rich, you may need to update your vocabulary, and if you change your vocabulary, you may speed up your ideas. For example, if you use the words high-paying job, these are slow words, and cash flow are fast words. My poor dad always advised, get a high-paying job. My rich dad always advised, you want cash flow from assets. See the difference. Finding a high-paying job may seem like the fast way to get rich at the start, but in most cases, it is the slow way to become rich in the end. Few people ever became rich via a job, even a high-paying one. Cash flow from assets is better than income from a job. As Rich Dad said, There is more to being rich than having a lot of money. The rich use a different set of words, and those words guide them to different life experiences. Experiences such as learning how to raise capital rather than save money. The words save money are slow words, while the words make money are fast words. In principle, as long as there are a ready market of buyers and sellers for whatever you may produce, then you are, within this context, making money. My books and audio cassettes are a form of making money. If I were a doctor who had to personally work to get paid, then I would be a doctor who worked for money. If I were a doctor who invented a new medicine and sold it in the form of a pill through pharmacies, that pill would be a form of the doctor making money rather than working for money. Another slow word is appreciation, while depreciation is a fast word. I hear friends say to me statements such as, "I bought a lot in this new golf course community. It's a good investment, and I expect the lot will double in value in 5 years." To them, such returns are a good investment, and hopefully they will realize a doubling or appreciation of their money in 5 years. Rich Dad taught his son Mike and me to use different words. When it came to buying any investment, he always said, "Your profit is made when you buy, not when you sell." Rich Dad invested for immediate returns in his investment, or cash flow. He also invested for a thing he called phantom cash flow, aka depreciation. He loved immediate cash flow and depreciation because he did not have to wait for his investment to appreciate in order for him to make money. He would say waiting for a stock or piece of real estate to appreciate in value was too slow and too risky. If you use the words avoid risk, these are slow words. But if you say gain control, these are fast words. Rich Dad told me, in order to be a player on the fast track, you will need to have a plan on how to gain more and more control. On the fast track, it is control more than money that counts. Considering risk versus control, Rich Dad said, the more a person seeks security, the more that person gives up control over their life. Today I see two worlds evolving. One world is the world I call the responsible society. It is the group that believes in being responsible for their lives and the ultimate outcome of their lives. There is another world that I call the victim society, which is the group that believes that someone else, a company, or the government is responsible for their lives. In any group, family, or company, there are usually both types of societies. Both see the world from their own context or reality, and both seem to think they are right. I have found that one of the dividing factors between both societies is their core view on the ideas of risk versus control. Victims tend to want to give control over their lives to someone else in order to avoid taking risks. Then they get angry when they feel someone abuses the control they granted the abuser in the first place. In other words, victims are often victims of themselves. Mutual funds are also slow words. 506 Regulation D are fast words. The reason I say that mutual funds are slow is because the big profits or appreciation in any paper asset is made at the formation of the company, prior to the company going public. When rich investors begin investing in the share of a company, they are often investing according to the terms and conditions spelled out by the Securities and Exchange Commission, SEC's Regulation 506D, and other such regulations. In other words, the rich invest in shares of a company when the company is still a private company. The public invests in shares of a company after it becomes a public company. The differences can be enormous. For example, if you had invested $25,000 in Intel prior to it going public, that $25,000 might be worth more than $40 million today, depending on the ups and downs of the stock market. This does not mean mutual funds are not good investments. For most people, mutual funds are great investments. But they are better investments if you know what you are doing, know what the risks are, and know the big picture of the whole game of investing in stocks and mutual funds, public and private. Knowing the words, vocabulary, and the jargon of the investments of the rich improves your chances of becoming richer quicker. The leverage of integrity. From 1985 to 1989, Kim and I did not have any passive or portfolio income. We were working diligently at building a business so that we could have more leveraged earned income. All the extra money we earned went back into building the business. As the years crept on, I could hear my rich dad saying, "The moment you make passive income and portfolio income a part of your life will change. Those words will become flesh." Both my dads were sticklers for knowing the definition of words. They also said, "You're only as good as your word. People who do not keep their word are not much good." One of the reasons so few people retire young and retire rich is that they are not true to their word. They use words that to them are not real. If you want to change your financial future, One of the most important and inexpensive steps you can take is to know the definitions of the words you use seriously. Some of the more basic, fundamental, and important words to understand are your personal current ratio, quick ratio, liquidity ratio, debt to earnings ratio, as well as the difference between assets and liabilities, and earned, portfolio, and passive income. All of these words are defined and explored in my previous books and audio programs, particularly Rich Dad's Guide to Investing and Rich Kid, Smart Kid. Harnessing the power of words. Why are words important? Simply because the concepts behind them can be useful to you and your life. For instance, understanding basic ratios, such as debt to equity or liquidity ratios, can help you in gaining your financial freedom. Let me explain. A useful ratio is your debt to equity ratio. For example, if you have long and short-term debt of, let's say, $100,000 and you have $20,000 in equity, then your debt to equity ratio would be 5 because you need to divide $100,000 by $20,000. The question is, what does this mean? Well, in reality, it means very little. Yet if next month your ratio is 10, that might tell you that you could be mismanaging your life. A debt-to-equity ratio of 10 could mean that either your debt has gone up to $200,000 or your equity has dropped to $10,000. In either case, those numbers have more meaning because they are real numbers that relate to your life. As Rich Dad said, mind your own business. And knowing these simple ratios are excellent tools for teaching yourself how to mind as well as manage your own business, the business of your life. One of the ratios Rich Dad had me watch and monitor was what he called the wealth ratio. His wealth ratio was passive income plus portfolio income to total expenses. The goal of calculating your wealth ratio was to have your passive and portfolio income equal or exceed your total expenses. This would mean you could quit your job, earned income source, and still maintain your lifestyle. Once your passive and portfolio income exceed your expenses, the ratio would be 1 or higher, and you would be out of the rat race.